second hour of TheoTrade. I am Professor Jeffrey Bierman. I am broadcasting live from Chicago, and today is Thursday. It is February 18th. It is 2026. Good morning, TheoTrade members. I actually have time to say hello instead of skip over because I see Florida Woody. Hello, Rosario. Butts is there. Judge Smalls is there. You're on the got the gavel going. Kosher, Rodney G, Ship, Kristen, John O'Donnell. Good morning to everybody. Like I said, depends upon what side of the market you're on. Listen, I got a good program for you today. We're going to pick it up near the top of the hour. We're going to do part 3 because it's a 4-part series, possibly 5. Actually, it's a 5-part series. We'll do part 4 today, talking about changes in momentum, because you're witnessing changes in momentum in real time right before your eyes, and I don't think people are picking up on it. We will get to that. We talked about Bollinger Bands yesterday. Today we're going to talk about the rate of change indicator and the MACD, which is my all-time favorite indicator. They are momentum indicators. They are not trend indicators, but they do have a trend element to them. And we'll use that to help you spot changes in momentum so you can position yourselves around indices, individual stocks, or other types of products. Now, without further ado, I want to get to today's theme. I've been holding back for a while. I woke up this morning early thinking, well, where am I going to go today? Because every day I have to come on here and I have to be kitschy. I got to be edgy. I got to be vituperative. I got to be sarcastic. I got to catch your attention somehow, at the same time educate you. So today's theme comes courtesy of the game. It's a blocks game called Jenga. At my mother-in-law's house, they have 2 boxes of Jengas. My daughter and my nephews still play it, and their ages like 12 to 16. So let's talk about Jenga. Let's talk about the history of Jenga. And let's talk about why this market is not long for this world. You're playing a game of Jenga, and it's going to hit you one way or another. And I keep telling you this, like, it may be next month, it may be tomorrow morning. I don't know. I don't care. I'm out early. I'm in early. That's how I make money. I don't time it perfectly, but I'm pretty good at figuring ranges out. So what's Jenga? Everybody remember Jenga when you were a kid? Or maybe you're an adult who goes to some type of party of a neighbor or relative, Thanksgiving, Christmas, and you pull out the old Jenga board. There's Jenga. And there's the Jenga board blocks. Everybody recognize that? Oh, Julie, it's a great game. I'm not too skilled at it. My daughter's actually really good at it. And my nephew, who wants to become an architect and engineer, is phenomenal at it. So Jenga is a game of physical skill, and it was created by British board game designer and author Leslie Scott. So if you want to like go to a Trivial Pursuit party and impress somebody to grift them out of money or trying to get somebody into bed, the answer is Leslie Scott. He's a British author, and he designed the game, and it's marketed by Hasbro. So the name comes from the Swahili. Get this, it's a Swahili word. As an African, Swahili word kujenga, which means to build or construct in Swahili. So players take turns removing 1 block at a time from a tower constructed of 54 blocks. Now, I don't know why the magic's number is 54. All I can tell you is it's 54 blocks. And each block is removed and then placed on the top of the tower, creating a progressively more unstable structure. This is obviously where I'm going, people. So the game ends when the tower falls over. So if you're the last man, last woman standing, you're the winner. So just a little history. It was created by Leslie Scott, the co-founder of Oxford Games Limited, based on a game that evolved from the family in the early 1970s, using children's wooden building blocks, which the family purchased from a sawmill in Chokoradi, Ghana. I had a roommate from Ghana in college, so interesting stuff. The name Jenga is derived from kujenga, a Swahili word which means to build or construct. So Scott was born in Tanganyika, now Tanzania, where she was speaking English and Swahili before moving to live in Ghana, West Africa, full time. Scott launched the game she named and trademarked as Jenga at the London Toy Fair in January 1983 and sold it through her own company, Leslie Scott Associates. And the blocks of the first sets of Jenga were manufactured for Scott by the Camp Hill Village Trust in Button, Yorkshire, England. And to put a icing on the top here, the V&A Museum of Childhood has exhibited one of the original sets of Jenga since 1982. Okay, in 1984, Robert Grebler, an entrepreneur from California who was the brother of close friend of Scott, contacted her, expressed interest, and then eventually got her into Hasbro, and it took on a worldwide phenomenon. So if you ever see what Jenga looks like when it's about to fall over, okay, this is, Jenga. Okay, there's Jenga when it falls over. Take a look at this picture. Emblaze it in your head, you permabulls. Look at it. That's the market eventually. When's it going to happen? I don't know. Maybe it's tomorrow. Don't care. I have so much cash. I'm just going to buy everything, get rich, and just Jimmy Crackhorn. I don't care. I don't know why any of you are sitting around waiting for this to go higher. You have no reason to own anything here, except maybe individual stocks like myself. But to own the S&P 500 to me is suicide. I think you're cruising for a bruising. When the market does fall over, oh, you're going to know. It's like, how will I know? Maribozu candle, massive volume, taking out 68, 6,600, and the speed of the move is going to feel like Jenga, the board game Jenga, because it's going to be rapid. There's just no way you're going to tell me you're getting out, because you're not. It could be a gap and go. It could be just like, oh my God, it's just down 305 minutes. It's just, why wait? Why are you waiting for catastrophe? You know it's coming. The market's a Jenga game. Let me prove it to you. Let's talk about like themes. So here's like good news, bad news. And people say, well, lay it on me. What do you mean good news, bad news? Okay, I call it heavy lifting. So yesterday, why did the market rally yesterday 42 before it just faded? Kaufman faded and it made money like he usually does. Like, why did the market fade? Here, I'll tell you why. So the U.S. industrial production numbers came out yesterday, and they were good. Yay! They was the strongest output in nearly a year. It was the strongest output in nearly a year, and everybody's celebrating, and they're running up the market, and this is all good, right? It's all great. No, it's not. No, it's not. And you're like, but why? Because that industrial production number tells you the Fed's not going to cut rates. And if you don't believe me, you don't want to believe me, right? Pick up the news, people. I call it sticker shock. You know, like you look at a car and go, damn, I wanted to pay 40 and it's 75. You get that sticker shock. Well, the Fed got sticker shock yesterday because one of the Fed governors came out and said, quote, and I quote, said that the Fed minutes reveal talk of possible rate hike if inflation doesn't cool. Didn't I tell you? Sorry, Garrett. I warned you about this. I told you, don't wait for a rate hike. It ain't coming. And if it does come, you might get one for the entire year. We have a problem. Houston, we have a problem. Okay, I'm just the messenger. These are the Fed minutes. These are the people who control the monetary policy. Forget Bierman. Who am I? Listen to what they're telling you. The Fed minutes showed that 3 of the Fed governors, 3 of them voiced an actual rate hike. He's going to rescind the cuts. You can put in all you want. You can get rid of Powell and you can put in anybody you want to, Warsh. Nobody cares because they can't cut rates. You can't cut rates at an all-time high. You will not. You cannot. Ask Gianni. It's not going to happen. You can't, because all you're going to do is create a bigger bubble that we're already suffering in. What the market needs is a garden variety 10% correction to 6,000, overshoot to 5,500, takes the edge off, allows the Fed to go, well, wow, the market's in trouble. Let's do a rate cut. But you can't do a rate cut when you're in a bubble. It just doesn't make any sense. And screw the stupid job data. The job data comes and goes. Nobody's hiring. Nobody's firing. We're just flattened out here. AI's taken over the world. The profitability that you're seeing in these companies comes from AI. AI makes everything efficient. It allows you to eliminate excess fat in the company, pad your profits, even if revenues aren't going higher. And the market reacts to revenues sometimes, but mainly to cash flow and earnings. So I'm telling you right now, you got sticker shock from the heavy lifting. This is not something I'm going to sit and wait. Good luck, people. When it's down to 6,000, are you going to sit and wait? Why don't you just get out now? But it's going up 80. Then let the intraday traders like Rego and Rosenblum trade with them. But don't tell me you're position trading here. You're out of your mind. Number 3, size matters. This is, to me, really, really disturbing stuff. This is not what you want to hear. Not. Citadel is the fortress. Citadel is the most secretive, biggest liquefied company in the world. The biggest company in the world is BlackRock, but everybody knows what's going on. They've got their own, like they're always front and center somewhere on TV, on Bloomberg, CNBC, Rick Reader, whatever. Somebody's out there talking. They're right in your face. Citadel and Ken Griffin prefer to hide in the shadows. That's their style, right? Moved from Chicago, have their operations now in Miami, okay? Citadel has got all these multi-million-dollar gurus. They handpick these people from all over the world, all these like PhD cranium, like astronauts of science and like financial number crunching Armageddon people. They're incredible. Like they make me look like an intellectual midget. So they pull out this guy who comes, his name is Scott Rubner. And Rubner is their money flow guru. Where's the money going? He's tracking the money trail, and he's a technician. What he saw was, he said, he sees unprecedented retail trader participation. Now, you're going to think that this is a really good thing, but it's kind of double-edged. So what he saw was, he noted in a note that he put out yesterday to his clients that the retail participation at this juncture of the market cycle is, quote, historically elevated with significant buying, not selling. Retail is bullish, not bearish. They're not hedging at all. The hedging is done on the institutional side. Retail's like YOLO. You only live once. Let it fly. Let's buy everything here. So they observed it across all sectors, cash, equities, crypto, options. Rubner emphasizes that this structural shift from institutional to retail indicates a new chapter in market dynamics, where retail is now what used to be a kind of like secondary source of demand. It has now become the primary source of demand in this market, challenging traditional institutional narratives. Now, here's the thing I'm going to tell you. Now that retail controls this market because we're in a vol box, okay, that is the equivalent, okay, of it's like, seriously, it's moving large chunks of money, which are sitting there because all these institutions are looking around going, I'm not buying, are you buying? But they're not selling either. The institutions are not selling, they're not buying, but they're hedging. And now the day-to-day movements are controlled by retail. And retail accounts for literally less than 1% to 2% of all market on a daily basis. So 2% of the market that's traded on a daily basis is now controlling the intraday movements. And if that doesn't scare the crap out of you, I'm never going to get your attention. Because what's going to happen eventually when we break 6,800? Retail is going to sit there and go, damn it, gotta sell. Well, when they start selling and the institutions are like, well, we're not buying, what will be the source of inflow to drive the market up? There isn't one. We have a structural problem, people. There's no money really going into the market. It's just recycling itself over and over again in this sideways flag formation vol box. Size matters. I would rather have institutional money driving the market than a bunch of people buying 25 shares on the margin to keep this market up and zero DT. That's not the sign of a healthy market. You're on borrowed time, people. You know it. I know it. Everybody knows it. Everybody's waiting for somebody else to pull the trigger and to jump the ship. Don't sit around waiting to jump the ship. Just raise cash like me. I just sat here. I made a little purchase yesterday. I got 55% cash. If the market goes up, I'm still in it. If the market goes down, I have so much money and flexibility, I can do whatever I want. It's not about timing. It's the recognition that the market is in a bubble of all sorts of bubbles here, and you can't game the system forever. You won't. So be aware, the market is in Jenga. Structurally, each day, another support is being taken away and put to the top of the market, and it's making it top heavy. And eventually when it's top heavy, and it's like bottom light, it just rolls over like a gigantic tsunami, which is what I referenced. That's the lesson you're learning. Now, individual stories today is it sort of a different animal altogether. So let me try to put this together if I can for you. My first one's called road to perdition. And if I cannot make you laugh, tee-hee, or giggle on that one, I'm friggin' walking out the door. That's the best one I've laid on you all year. Road to Perdition. Remember the Tom Hanks movie with the devil? Okay. Road to Perdition. I got to give a lot of credit to Kaufman, a lot of credit to Brandon Chapman. They picked this off from a mile away. Now, this isn't my style of trading. Jeff Bierman, the president, we don't play that game. Homie, don't play that game. But if you're out there playing Brandon Chapman, Jesus, man, this is how you make it work. So Carvana is bouncing around here. The low print is 273. No way. Yeah, way. Look at that low print. I got to bring this to you. 328. No, it's not. No, it's not. They reported after the close yesterday. So you got to get with the program. Look at that. Sorry, I stand corrected. 271.3 is the low print. I'm just like, whoa, woo-wee. That's like what? That's like, I think the expected move was like 45 points. That was almost double the expected move. That's fun. That's how you get rich. But if you're in an option, you're screwed because you can't trade options after hour. Nevertheless, if you bought puts or sold call spreads, you maxed out. You made a 100% return. So bravo to those who follow Brandon Chapman. Brandon was leaning bearish on this. He said, better watch out for that Carvana. Okay. This is the only thing I'm going to lay on you with this because this stock is a complete joke. This is the kind of stock that when I ran a hedge fund once upon a time, 25 years ago, we used to call these stocks widow makers. These are the type of stocks where money managers would go in and they'd say, well, I'm kind of tracking the S&P and I've got to add something that presents a form of alpha that allows me to get that bump, right? That extra bump in my return. So they put their money in something like this and going, oh, you know what? It was like the internet days. This is the kind of stock where nobody knows what it's worth. Nobody. The people who trade it don't know what it's worth. The analysts don't know what it's worth. The portfolio managers are just liars. They don't know what this is worth. There's no way to know because there's no way to figure out. Their accounting is completely wonky. Nobody trusts their accounting at all. They do all, ask Blake. They should make up their numbers are freaky. Like I can't even imagine the auditor they pay to look at this going, we're going to give a non-qualified opinion, which means they think it's okay. They don't know. All you're doing is you're trading purely on narrative, supply and demand, and prayer. That's not the type of stock I would ever trade, personally. There's no way I'm going to go near this. But the stock itself is now down to 332. They earned 422 and beat that number. How the hell did they beat by $3? That's cooking the books. That's a lie. You can't fool the market. The reason why the stock is down 29 has nothing to do with their aftermarket narrative. It's not about guidance. That's a lie. The reason why the stock's down is because the market's telling you and voting with its feet going, they're just lying. They lied. They completely lied. That's impossible to get that. How do you beat by 400%, 300%? I'm sorry. There's just no friggin' way you can beat by 300%. There's no way unless you're cooking your books. I would advise all of you, if you're going to trade this stock, you can only trade it two ways. You can only trade it by options. That's it. Spreads. That's it. There's no other way to do this. Either an option or an option spread. Or if you trade the stock, you buy tiny amounts and you hedge immediately when you buy it. I think one day, this stock is going to be exposed for accounting irregularities. And that'll be the last time people ever trade this. It'll be like GME, like GameStop. People look at it and go, it's a gamma squeeze. And they're going to say, listen, we can't trust it. You can't go from 64 cents to 422. That's impossible. It's impossible. If I were you, any of you, I would sell this stock and never come back, ever. Like I wouldn't even buy it if it went to $9. This is an absolute scam. I've been doing this since I came out of my mother's womb. I can read balance sheets. I do it for a living. This makes no sense whatsoever. It's impossible. Now, if this were something like NVIDIA, it might be possible. But even NVIDIA wouldn't, even Jensen Huang wouldn't pull one of these craps. Avoid this stock like the plague. Get out of it and never come back. That's the lesson you learn from me. I'm doing you all a favor. Walk away. Look away. I'm hideous. Get away from this thing. It's going to bankrupt you one day. The numbers are just fake. Next on this one, Sam's Clubbed. So Walmart delivered numbers. They They delivered numbers. And I'm going to show you something interesting. So the shorts got squeezed early. Don't worry. You're going to be fine. Go back in there and short. I told the Genesis Cog members that if this stock breaks underneath 129, go after it, attack it, buy puts, sell call spreads, and ride this to hell. That's what I told them, because this is a Genesis Cog short. I'm telling you, it had to break 129. That's the key. It had to break 129. Had to. Otherwise, the algorithms will keep buying this. So I said, look over here. Come on, give me the trend line. And I was like, listen, I don't like trading at earnings, but I'm in a spread on this one. I'm in like a 125, 130 on this one. So I'm okay. I got 30 days. So I'm fine. Definer a spread. But I'm looking at this and I'm like, oh, look what happened yesterday. You're on a bearish divergence. So that favors the bears. You're on a bearish MACD. That also favors you. You're also on a bearish Stochs. So you've got 4 sell signals here. Now you're going to stop and think to yourself, well, then why did this rally? There's 2 reasons why it rallied. Forget about anything people on television tell you. It's just fodder and nonsense. It's white noise. There's 2 reasons why it rallied. One is because the fact of the matter, it had already sold off. It already sold off to 121 in pre-market. So that was a $13 hit from where it hit the high on Monday, or rather Friday. That's why. So that $13 hit represents the, Corey Rosenblum, Blake Young bounce. That's the 10% bounce, and there you go. So that's why it bounced. That's one. It's a technical bounce. The other reason why it bounced is because, and you have to understand this, the narrative and the way the algorithms are programmed is they change every day. One day it's risk on to risk off. The next day it's risk off to risk on, which means yesterday Walmart got whacked. So naturally what's going to happen is it's going to be up today. So let's just say Walmart doesn't report numbers. It still would have been up $3. It wouldn't have even mattered. Like the earnings report had no impact. Whenever people, these money managers, crap the bed and wipe their ass, they go, buy me Walmart. Like Don says, I'm frightened. What do we buy? Costco, Walmart. Every time they're nervous, it's J&J, Walmart, Costco, to hell with valuation. All 3 of them are bubbles. So money managers have not been whacked yet. They haven't been what I call Amazonized. They haven't been Disneyized. They haven't been Lululemoned. Eventually, when Walmart gets cut down to 75, 60, and 50, these managers are going to go, what was I thinking? You cannot buy on narrative. It's the biggest, dumbest idea ever. Don't buy on narrative. Buy because it's cheap. That's why you buy. This stock is still going to go down. This stock is still going to be laid to waste because the earnings just simply stunk. They beat by a penny. That is not enough. Not. The earnings sequentially went up from last year to this year about 11, 8, 10%. So the multiple on the stock at best should be 20. Then why the hell would any of you pay 44? I'd fire you and I'd sue you. What are you doing? You don't need to short it. You don't. But you don't need to buy it either. The earnings are not good enough to justify owning this. If I were you, I'd get the hell out of this. All of this, all of that is short covering. All of it. And now you're stuck sitting here and the institution's like, great. Some of the shorts ran it back to 130. Gives me a chance to get out. You're screwed. If you bought this stock at 130 today, you're screwed. Because there's no reason why this stock is going to stay up in the longer term once that S&P corrects. The weekly never lies. The weekly is curling over. Give it a month, 1 month, and that stock should be somewhere in that 120, 115 range. People, give it time. Again, Tony Rago asked earlier, the most important skill I can never teach any of you. You can come to all my classes. I cannot teach you patience. I can't do it. I'm not going to. I can't. You have to be patient. Nobody's more patient at Theo than me. Nobody. Probably maybe Gianni's close. You have to take it and you got to be vigilant and you got to ride it. You got to set your stops and your take. But tell me, if this goes down to 121 and you bought it today and you're a money manager, your career is over. Why the hell would you buy a stock at an all-time high where the earnings were not even that good? The stock is overpriced. and the market itself is on the fringe of some type of greater correction. This will be the stock that will lead the market lower once the MACD rolls over. All you got to worry about here is don't get caught around that dividend, but that dividend is so small, it's worth taking the shot. That's the lesson you learned from me today. God, I can't stand Walmart at all. Every time it rallies up, I love shorting it. It's one of my favorite things in the world. Next on the dash of hot sauce. You like that one? A little dash of hot sauce? Come on. I put a lot of thought into this. I need Lisa Simpson. Oh, please validate me. Oh, please validate me. So let's talk about Dash. Now, I got nothing against Dash. Okay. I've done Dash before a couple times in my life. They charge an arm and a leg. They're rip-off artists, and people who are the new generation of millennials are so friggin' lazy. They're like, I don't own a car, and I don't want to take an Uber, so I'll just pay somebody in an Uber to deliver me food. Great, go for it. So here's Dash. Did you buy it? Why? But the earnings came out and they were 48 cents. All right, work with me here, people. They missed. Okay, they missed, but it's already priced in. You're right, it is priced in. The reason why the stock went from 242 to 165, because it was priced in. So this is a dead cat bounce over an overreaction to the downside. Probably a lot of people thought, this is just a speculation on my part. A lot of money managers thought, I think they're going to deliver 35 cents. That's why they knocked it down. Oh, wait, they delivered 48 cents? It was not as bad as I thought. Therefore, I will go in and buy it. That might be one logic. The other logic is the shorts are just covering. The shorts are covering because the event occurred. Sell on the rumor, buy on the fact. Could be another one. But I tell you something. Just add up the last 4 quarters. Look at the sequential gain. This is a good sequential gain. It's not sweet. Sweet. Nice. It's about a 40% gain. That's pretty damn good. I'll give Dash a lot of credit. They're monetizing. They're making really good strategic moves. The stock is not as expensive as it used to be. They're in your face. I think Dash is great. Now, I'm not going to call an order of Dash, so I got nothing against the stock. But I keep telling you, if you're paying up for that much, you're out of your mind. I would fire you or I would sue you. You can only pay a 91 multiple for something like Palantir, Oklo, QBTI, quantum computing. That's okay because there is so much sequential growth there. But you can't pay 91 times earnings for a company that's been around 10 years. You can't do it. If you did, you put yourself at massive risk. The stock has earned about, you add up the last 4 quarters, $2. Divide $2 into 181, you get a 91 multiple. So that is an actual good reading. But to justify that number, 2 things have to occur. They cannot miss the estimate, which they did, which disqualifies that number, which means you're paying up for a stock that's a bubble. And the second is, to get that, to justify that number, they would have to have reported 100% jump in earnings. If they did, then maybe the stock would be above that 200 level. What would I do if I were you if I own this? Okay, put up a long-term chart. Stop your nonsense. I don't care about your short-term garbage. Look at the long-term, because if you get the risk wrong, there is no reward forever in the business for you. This is a logarithmic, algorithmic walk down. It's still on the way down. It looks like it's still gaining traction month by month by month. If I were you, I would trade this stock. I would never invest in it. The only way I'm investing in Dash is if that stock goes underneath 100, I'm backing up the truck and I'm going to own the company myself. I will, but I'm not going to pay 91 times earnings for an algorithmic descending channel for a company that missed earnings. You're buying it for all the wrong reasons. You're being suckered. People get so badly suckered in this business. Don't get suckered. Hear me out. My expertise is risk management. I don't lose a lot of money on trades. Okay? Everybody loses. I lose sometimes. But this is too much risk for the average individual. If you're going to trade it, trade options, trade it from week to week or day to day. Don't buy this and tell me you're going to hold this to go to 400. You may hold it until you have 1 foot in the grave and never see 285 ever again. Last but not least on this. Okay? Last but not least. Oh dear. Oh dear. There's nothing I can say other than this because this surprised me. I don't short deer. Like there are certain sacred cows I never short. Would you like to know what they are? I never short Apple. I never short NVIDIA. I would short Palantir, but I'll never short NVIDIA. I'll never short cat, I'll never short Boeing, and I'll never short deer. Okay, these are what I call Bierman sacred cows. Even if they're bubbles, I won't short them because they're too highly liquid and they're too institutionally owned, and I can get my ass blown out. So here's John Deere. Now, it's up $72. A few things afoot. This is totally unshortable because the MACD is parabolic. If you shorted this, I would tell you right now, your career is over. You short this at a Citadel, a BlackRock, they would dismiss you. You would literally find yourself on the street and you'd be blackballed in the business. You can't short this. It's just unshortable. It's parabolic vertical. And if you want to go intraday, it's even worse. The 4-hour is sitting there and it's suffocating and squeezing every short to death. It's parabolic vertical. Okay. What would I do if I owned it? I would sell half. That's what I do. But I wouldn't necessarily step in and short. I think it's a little bit early. I think it might be a bit of a gamble. They might run it to 700 for another day. Who knows? But this is the thing you have to understand about this. The earnings were good. They were realistic. What you got from Carvana is BS. It's accounting nonsense. It's mythical accounting. It's fake. This is the real deal. They get audited. The earnings were good. Okay. And this was supposed to not their strongest quarter. So it's running and gunning. They gave good guidance. All I can tell you is because of what this did, it is going to automatically put a put on the floor on the S&P. This stock saves the S&P. Every day you wake up and you see a cat or a deer, it offsets the Microsoft. It offsets the NVIDIA. It offsets all the technology stocks that get beat. You have Applied Materials offset the loss here. That's what's happening. It's a structural rotation. So because of this stock alone saved the S&P today. That's it. If this stock is down 100, the S&P is down 50. This alone it's a psychological bottom on that stock. Just want to throw that out there. Would I short it? No. Would I buy it? Are you out of your mind? Is it a bubble? Not necessarily. Because this is not the right number. Their PE ratio is down to about 22, which is a little expensive, but it's not bubblicious. It's not a bubble. Be careful. Don't chase it, but try to avert shorting it. There's a lot of people who built in short positions who are getting killed. I always tell you, if anything, don't pick a direction. All you had to do was buy a straddle. If you had bought the straddle, you would be right now buying a Mercedes. Buy a 2-lot on the straddle, and look what happens. The straddle was $34. Look, you'd be up $38, $3,800. All you had to do was buy the straddle. Don't pick a direction. Hedge it with the put. Lose a couple of $5 on the put for a $72 gain. It would have been it. All you had to do was protect it. That's it, or straddle it. That's all you had to do. Learn next time not to make that mistake if you did. All right, let's move upward and onward, and let's get to what I call today's rate of change and MACD indicators. I'm going to put them side by side. They are not the same thing. They are not the same thing. But the whole point is we're looking for ramifications of changes in momentum. So when the levy breaks, it doesn't mean it just breaks bearish. It doesn't breaking bad, No, it's not just breaking bad, okay? It's breaking bullish. It's like that hockey stick move. And the most sound, efficient, leading way of identifying when you could be losing your footing in a trend or when a new trend is about to be established with a gamma squeeze is applying a channel, which I love doing, identifying flag formations, candlestick patterns. But for me, like I use as many tools at my disposal as I can. I really do. But for me, the crowning glory of all, to me, always lays its hand in one thing and one thing only. It always comes down to the slope of an indicator. You could come at me and say, I don't use your indicator. Okay, you don't have to use mine. You're your own person. What do you use? Okay, I don't care what it is. The most important thing in the indicator is not even the indicator formula. It's not. Because every single indicator, if you ask Kaufman, because he makes fun of it all the time, and he's right. Kaufman's like, useless. In a sense, he's right. In a sense, he's wrong. But the right part is every indicator is a reaffirmation, a reformation of the same indicator. Every momentum indicator is just, I'm going to construct something differently with a moving average or this or that. But the whole concepts are all the same. You're trying to identify changes in price action. And when it comes down to it, if you can identify the slope, you're a millionaire. That's how it works. It's like, people like, I use rate of change. Me too. I use the MACD. Your rate of change sucks. Who cares what you use of any of the four of these? It's that slope, man. If you get that slope, okay, you're smart. You ignore that slope, you're a slope of dope. You just miss what's going on here every time. So today, I'll just introduce two indicators. One, which is what I call like really like simplistic and rudimentary. The other one's a little bit obtuse. It takes time to explain it. I don't want to explain it. Why? Because inside my archive, go to Jeff Bierman, go to the TheoTrade site, go into where it says archives, click on it. There's a Kaufman archive. There's a Corey Rosenblum archive. It's all kinds of archives, class archives. There's a Jeff Bierman one. Click on it. You go to my archive, 11 categories. One of them is momentum. Okay. Go nuts on the MACD. You don't need to reach out to me. It doesn't bother me, but it confounds me why people say, can you explain the MACD to me? We have 100 coaching sessions on it. Pick your poison. Go for it. It's like a kid in a candy shop. The reason why we created the archives is so you would never call us, because we explain it all through them. We are the Library of Congress of Finance. We're it, people. You don't have to call us or send us an email. Just go into our archives. You'll find whatever you're looking for. There's thousands and thousands and thousands of coaching sessions there. And I have at least 30 or 40 on the MACD, probably 35 if you want to learn it. So I'm going to give you a Cliff Notes version on this. I'm only going to use to start Advanced Micro. Advanced Micro. I'm going to go to the rate of change indicator. So the rate of change indicator, rate of change, defaults to 14. What does that even mean? It means the length is 14 days. How do I know it's days? Because I'm looking at a daily chart. Whatever frequency I use, there's the aggregation, 6 months, there's the frequency. Whatever the frequency is, it corresponds directly to the length. That's all you need to know. It defaults to 14. Why? Because that's the Wells-Wilder favorite. 14 is it, people. There's 20 trading days a month, and 14 is like there. You've got the Mark Chaikin 21, you got the Bollinger 20 length. It varies. Takes a village. Some people like the 13 Fibonacci, some people like the 21 Fibonacci. I don't know. I don't care. Pick what you want. I just like to leave the default because I'm not going to recreate the wheel. They back tested this for years. Why do I think I'm smarter than them? I'm not. I just know how to use the indicator really well. So I click on this and I get rate of change indicator. Now, the rate of change indicator and the momentum indicator are exactly the same indicator. See where it says momentum down here? There's a momentum indicator right there. They're identical. The only difference is the rate of change measures change by price action, whereas momentum measures it by percentage. You have to look at one's by percentage, one's by integer price movement. So you go to rate of change, you click on it. I'm going to change the color, and I'm going to change the width to there. I'm going to change the color straight up to this color here, and the lower to that color, and we'll go with it. Rate of change, and we'll leave the zero line as it is. Okay. So here's the thing about the rate of change. You put your foot on the gas pedal on your car. You look at the speedometer, and the speedometer goes vroom, vroom. That's rate of change. Rate of change is you're moving in a given direction. And the greater the torque, the greater the price movement in that direction by strength and by duration and by time. That's what it means. Vroom. So the key to this indicator is really simple. The zero line is the delineation point. Fancy word, delineation point. It's the crossover. Anything above that zero line, anything above it is simply trend. So if you go above that line, you're in a bull trend. That's what it means. You go below the zero line, you're in a bear trend. Okay, this is easy. I can explain it so a 5-year-old can understand this. Above the line, bullish. Below the line, bearish. That's simple. Really, that's all it comes down to. What this oscillator, because it's an oscillator, it oscillates up and down. What does it represent? It represents the speedometer of the movement on a 14-day continuously additive basis moving forward. That's what it does. So the steeper it is, the faster it's moving in that direction. The steeper it is to the downside, the faster it's moving to the downward direction. See that? That's like, woo, fast. That's like, it's slowing down, right? And now it's decelerating. Now, here's the thing. The rate of change line is not a trend indicator. That's where people continually miss over and over and over again. Okay, technicians get it wrong. Okay, this is a momentum indicator. That's what it is. The line is momentum. It is momentum. That's what that is. But it ain't trend. Not. So you have a rubric. Think of a rubric, a four square. It's a four square. One of the squares says bullish momentum, bullish trend. The next square says bearish momentum, bullish trend. The next corner square says bullish trend, bearish momentum. And the last one says bearish trend, bearish momentum. That's what this does. It's so rudimentary. Literally, if you just follow this, you can read what the algos are doing in taking off edge and adding edge in and out all the time. People use the zero line as a trigger. That's okay. I don't. It means right here where it pops on advanced micro, look at that move. Okay, all this means is bullish momentum, bullish trend. That's what it means. But it's starting to come down in late October. Calm down, cowboy. This means bearish momentum, bullish trend, which means if you want to short this, go for it. But you're not going to get very far. Why? Because for you to break this, it has to be bearish momentum, bearish trend. If you spend the rest of your trading days at TheoTrade forever thinking this, you'll become a millionaire. I tell you, just think of this. I'm shorting. It's okay to short. But are you shorting into a bullish trend with bullish momentum? Good night, you're bankrupt. You can't do it. You can short into bearish momentum as long as it's bearish momentum. But if it's a bullish trend, you can't make that much money. You won't. Because the algos will come in and defend it like they did right here. Look, right there. I shorted at 260. Okay, it went down to 203. Get out. Why? Because you're in a bottoming formation on momentum. The idea here is when you shorted, even if you shorted late, I shorted at 232. It's okay. Why? Because you're shorting where there's a bearish momentum, bearish trend. It's called confirmation. Confirmation. Confirmation means you give up slippage, but you're riding both the trend and momentum, and they're aligned together. If you get that, I can retire and walk out the door. That's all you need to know. Seriously, when you're starting to like buy here, you're buying bullish momentum, bullish trend. It's going to be really hard for you to lose money. I can promise you. If you're shorting this, you have no idea what you're doing. You're fighting algorithms that are chasing momentum and trend at the same time. So the idea here is if there's a change in momentum, what are the ramifications? That's the question. See how this flattens out? See how that flattens out? That's bearish. No, it's not. Just because it's flattening out doesn't mean it's bearish. But it's the first step towards what? Breaking the trend. That's what it is. So logically, you could say, well, I don't want to short that trend. Then don't. That's like fighting Corey Rosenblum. Corey Rosenblum doesn't fight trends. He never does. But if you're going to short this, you have to be always aware. Am I shorting momentum or am I shorting trend? Because if you're shorting momentum and the trend is bullish, this is what can happen to you. You're sitting there going, singing your own, I'm so smart, I'm so smart. And then that happens to you. You're like, I'm so dumb, I'm so dumb. You're not dumb. You're arrogant. You're complacent. You don't understand. You're shorting bearish momentum. That's good. But you're shorting bearish momentum in a bullish trend. So you're going to get caught at some point. When the Genesis cog goes into short bearish momentum, we don't set long-term goals. We never do. Our goals are to grab 10% and get the hell out of that trade. Why? Because we know if we're shorting bearish momentum against bullish trend, we can't make that much money. That's why the Genesis cog does better than most of it, what you do. We make the recognition on the trade. Is it bearish momentum and bearish trend? Well, then let it roll, baby. But if I know it's like bullish momentum with bearish trend, I can't make that much money. I'm going to take that bearish zag up, but I can't make that much money unless the trend is bullish with it. Separate the two. Recognize trend and momentum, and you're good to go. What this does is it helps you understand, based upon the slopes, how strong that momentum is when that momentum kind of stops. Here, the momentum is not bearish. It's not. That's the mistake. That's bearish momentum. It's not. It's a little bit of bearish momentum, but it's an otherwise bullish trend flag. Here, that's bearish momentum, but because it's below the zero line, it's also bearish trend. So if you're like, I took the trade there, that's a good trade. Why is it a good trade? I missed 30 bucks. Because you're shorting into trend and momentum that are aligned. That's why you're making money. You're trading with an algorithm. An algorithm separates both trend and momentum, and most people don't. So if you learn how to distinguish between trend and momentum, you're halfway through making money right there. Because you're going to go like, I need to get out of this. I need to get into this. I don't hit home run trades. I know I don't. Nobody has to tell me that. I'm not in it for home run trades because I don't predict what the market's going to happen. I just look at what the momentum does from spot to spot, gravity point to gravity point, and pull the trigger and get out. I read the algorithm. I decode them. I'm like, can't make that much more money than this. Can't do it. I know I can't. But over here, I'm going to short there. I'm not going to short into a hole. If anything, I'd rather buy there. And if I buy and the momentum starts to go up, okay, you're buying in a bullish momentum. I know I am. But I'm buying in a bearish trend. So if I buy, I'm going to buy it at 204 and I'm going to make it to 260. No, you're not. You're not going to make it in a straight moonshot. You won't. Why not? Because you can't make it to 260 unless it goes bullish trend and bullish momentum. That's why this is bullish momentum, bearish trend. So if you bought there, you got to sell there. See the difference? There's a big difference. Why is it rallying here? Because it's bullish momentum and bullish trend at the same time. The zero line demarcates the trend. The oscillator basically signifies the momentum, and the slopes are everything. If you study the slopes, you'll get everything you need. Don't think, don't project, just react. Watch what the slopes are doing and watch day by day. And after a while, you're like, oh, I get this. You will. It takes a while. But if you sit here and watch every candle and listen to people on TV, you're lost. They have agendas. Don't have an agenda. Set target prices. Walk in, look to where you're going to get in, get out, and use that momentum and changes to figure out entry and exits. Now, let me throw at you the MACD. The MACD is a far, far more sophisticated, complex, obtuse indicator. Okay? Instead of having one line or one oscillator, it's got two. This one uses the zero line sometimes as a trigger. This one doesn't. What they have in common is the zero line. Because in the zero line on the MACD, if it's above the zero line, it's above. Bull trend. But it's below the zero line over here, Professor Bierman. Bear trend. Always separate. Separate. For the rest of your living, breathing days, separate trend from momentum. It will save you millions of dollars in the long run. It'll get you to stop projecting outcomes that cannot exist because the setup isn't like that. You can't have that. The setup has to be there to make it happen for the algos to make your dream come true. Rein it in. Beep. Back it up, people. So there's a bear trend. There's a bull trend. The histogram bars are just markers of momentum. So when the histogram bars are underneath the zero line, it's not about trend. The histogram bars have nothing to do with trend. Nothing. Nothing. Seriously. The histogram bars are momentum. That's the difference. Histogram bars equate to momentum. That's what they are. And what the lines represent are triggers. So on the MACD, when the blue line, which is the leader line, is above the signal line, which is the yellow line, it's a bullish signal. And when the actual blue line falls below the gold line, it's a bear signal. But don't confuse trend and momentum. Stop. This means bearish momentum in a bullish trend. That's the difference. That's how you figure it out. I want to short over here, right here at 1128, right there. You can. I'm not going to stop you. I'm not my brother's keeper. You're shorting into a bearish trend and a bearish momentum. That's why that trade works. But I keep telling you, when you look at the MACD, it's all about the way you process the MACD. It's about moving parts. It's like driving a car and saying, looking in the mirror, looking in the side mirror, there's a pedestrian. It's like a game of Frogger. You're looking at things and moving parts coming at you. There's wind. There's a yellow light. You're looking behind you. There's a car behind you. You have to pay attention to all of the components. One thing people often do is they're like, I get the trigger. I know you do because I taught you. I get the bull trend. I know because I taught you. I get the bear trend. I get the histogram bars because the histogram bars show the differential between the leader and laggard line. Got it. There's a bear trigger right over here. There's a bull trigger. That's a bull trigger. I even throw in the word bull trigger, but it's a bullish momentum trigger. Bull trigger. Okay, that means buy me. Buy me. Look what would happen. You would have killed it. Look at that. Bam. There's $50 right there. Took you a week. Honey, Mercedes. The one thing that everybody, even the professionals, miss this. It's the slope. It's the slope. It's not about predicting. It's making the recognition that if you track the slope, and I'm just telling you, if you track the slope, just track the slope, it will tell you everything you need to know as far as how long, or when you're on borrowed time, how much time have you got in this trade? So for instance, this is going vertical. You got all the time in the world. Why? Because not only is the signal line vertical, which is the laggard line, and the leader line vertical, okay, they're both vertical. The slope is so like aligned that your chances of making money shorting this are between a rock and a hard is zero, like a 1% chance of making money. I had a short at 223. Meanwhile, 1 week later at 270, you're crapping in your pants, changing your underwear. Not going to work. You can't short what's going up because no algo is short. The only person selling here is you. Like institutions will sell here to like take some risk off. No algorithm will ever sell. No, there is no algorithm in the world that's going to sell this. Not going to happen. Algos do not sell this and they do not sell that. You do. That is a parabolic move. You are in a bullish trend, in a bullish parabolic move. You're dead. That's what's happening to John Deere. You're not getting out of that. You're not getting out tomorrow, the next day, or the next day. You won't. You have to flatten out the slope. If you can flatten the slope, you've got hope. Algorithms have a way of processing the slope. They can see in a time elapsed as the slope's moving. When the slope goes flat, it means it's a two-sided trade. When the slopes are up, it's a one-sided trade. And when the slopes are steep, it is a 100% upside one-sided trade, 90 degrees. When the slopes are waterfall, oh no, look at that. There's no algo buying here, people. There's none. There's only you. I'm going to catch it at 228. Oh no, I'm down $28. Honey, take back the Mercedes. It's being repossessed. You can't buy that. You're riding an algorithm down. Just get on the back of it and buy a put and ride to hell. What this does is the slopes, they clue you how far you can go before you have to bail. They don't do it by the minute or the day. They do it by the slope. That's the key to the whole market. That's how the whole market works. And nobody wants to tell you except me. Why did this stock not go lower? Look at the slope of the MACD. Okay. Stop projecting. Don't tell me what's going to happen. You don't know what's going to happen. Just watch the slopes and let the slopes tell you what's going on. See how the MACD flattens out? When the MACD flattens out after a precipitous fall, it doesn't mean it's a buy. That's not what it means. It means that the potential for lower price levels is just not there because the slope or the momentum, the slope and momentum are the same. When the momentum flattens out, cover your short. That's how I do it. That's how I've been doing it for like 20, 30, 40 years, literally. As soon as I see the MACD flatten out, I'm like, I'm out of that trade. I'm done. I can't make any more money. I've maxed out what I can do. I'm not going to sit in there and go, I'm going to hang out for one more dime. Ask Kaufman what the most expensive dime is. The most expensive dime is the one person who said, I'm going to buy Carvana at 373. That's the expect. It's up 200. Yep. You have to look at the slope. When the slope flattens out, see how the slope flattens out? That's not a sell. It's not even a buy. But what it's telling you is for this cycle, this cyclical run, because it moves in cycles, it's done. We're done. Nothing to see here. This is a rebalancing of order flow. It means the buyers are in control. The sellers are getting wiped out. Oh, wait. Buyers and sellers are equilibrated. They are paired off. 50% buyers, 50% sellers. The algos read this and go, okay, we can now trade both sides. They'll then range it. Beep, 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 beep. It's like a pinball machine. They'll change the entire tempo control. But as soon as you break and change the slope, the algos are like, get on that parachute. Let's go. And they're going to kill the thing. They're going to wreck it. This could destroy it. That's what they do. Algorithms key off of slopes. So whether you're using a rate of change or a MACD or a Bollinger Band, Jimmy Crackhorn and Jeffrey Bierman don't care. Look at the slope. If you don't read the slope, you're going to lose a lot of money because you're going to get in late, you're going to exit early, or you're going to short early. You're going to make the wrong trade at the wrong time. I'm just telling you this as a friend to you. Let me show you what it looks like, okay, for the S&P 500, okay? I'll read it exactly as it were, okay? Don't think, don't project, turn off that damn CNBC. Just watch it. What is this telling me? What's it telling me? Okay, the slope is flat. So the downside's what? It's protected at 6,800. I can see it. The downside's protected. Look, it's flat. Where is the co-location of the ROC? Rate of change, ROC, rate of change. It's below the zero line. So it's a bearish trend. Why are you buying a bearish trend? Corey Rosenblum would smack you. You don't buy bearish trends. You buy bullish trends. Right here, that's a bullish trend. So you can buy it. This is a bearish trend. But where's the momentum? There is none. None. So those of you buying here, you're so courageous. You're buying a bearish trend with no momentum. That's why you're not going to make any money positioning. The only way to make money, there's only one way to make money in this, one way. You have to intraday trade or you can't make money. You'll make not a friggin' penny. No way. I'll bet against you 100 times out of 100. The only way you're going to make money is you have to intraday trade with Corey or Tony. You have no shot of making money. None. This is telling you right now, it's a bearish trend, so don't buy it. How about the MACD? Is it below the zero line? Bearish trend. What about the signal line? Bearish momentum. What about the MACD line? Bearish momentum. People, you have three bear signals. Like, I have no idea what any of you are you're trying to challenge me. I don't know why. Don't challenge indicators. I don't. That's why I avoid like getting killed. Bearish, bearish, below the zero line, bearish. I have three bear signals. I'm not even remotely interested in get it away from me. Look away. No way I'm interested in this. Zero chance I buy this. I may not short it, but I'm not going to buy it. You know you're in trouble. If this pivots down and starts heading lower, it's the end of days for you bulls. You guys are going to sit there, gals, you're going to scream and go, we should have listened to Bierman. It's not about me. It's the slope. The slopes are never wrong. You are. If the slope breaks, it's going down because the algorithms key off the slope. Your little, like one contract cannot hold up against Goldman Sachs' 65,000 spray VWAP spray. You'll get blown out in a hurry. Don't mess with this stuff. This is like it's just flat. Don't care. Once this pivots down, and by the way, the rate of change is not a bounded oscillator. It's unbounded. So how far can it fall? Forever, to hell, to 33 cantos underneath. This could go to negative 1,000. It's a bottomless pit. Bottomless. There is no top or bottom for this, or the MACD for that matter. So don't tell me this should hold. Says who? What are you, God? This could blow through, drag, and now we're at 6,700. You are buying into one of the most lethal markets I have ever seen. We're on the precipice of literally a meltdown. I told you, it's like a game of Jenga. I don't know why you'd mess with this. And then you got the weekly, which is rolling over and gaining traction. If that ROC goes underneath that line, you're in a bearish momentum, bearish trend. confirmation of a breakdown. If this goes through that zero line and it's working its way there, and people, I've been doing this for 39 years. The MACD weekly is never wrong. If that rolls straight down, that market's toast and you're going with it. You can't stop this thing because the algos will attack it. They trade slopes. The slope is starting to gain traction. That's why I tell you, I walk in there every day like Nostradamus because I don't think I'm right. I know I'm right. I fought these for years and lost millions. You can't fight these. I'm proof positive. So if this starts to break like this, you're not getting out of this. And stop looking for market breadth and stop looking for CNBC and stop looking for like a hope. There ain't no hope. They're going to take it down simply because it's overbought, it's overpriced, and the liquidity sucks. And we need this. It's healthy. On that note, I will come back tomorrow and I will complete the fifth wave, which is we're going to do the indicator called the Fisher transform, which is another indicator patterned after kind of like a MACD, but it's a little different. So be aware, watch the slopes, watch the change in momentum. I'm saving you a lot of pain, people, but it's down 25. I don't care if it's down 125 or 10. It's already set in stone. We've crossed the Rubicon. We're ready. We're primed for a correction. Don't care about deer. Don't care. Everything will be sucked down like a vacuum when this goes. All I know is I got a lot of cash and I'm on the sidelines and I'm talking to Gianni all day long. We're laughing about this. We just go, we'll wait it out. You can buy all this you want. I'm just going to wait it out. Only intraday trading will save you. On that note, where is Brandon? Whoever's going to spell me, because I've got to do a Genesis cog at 11:30. I'd have to skip my lunch. So ladies and gentlemen, thank you for joining me. I'm not sure who's supposed to come in here. I'm Green Man. Oh, I put up a green screen today. All right. Well, it is what it is. I thought I had put on the other screen, but I didn't. It is what it is. All right. So, let's see who's after me. Come on, baby. I need somebody to spell me because I got to go. Well, at least I can thank you all. I don't know who's coming up next, so let me check the schedule. And by the way, if you really wanted me to get the background the way I was supposed to, I'll give it to you. Here comes Brandon. I completely screwed this up, so I should have actually had a different, screen up here. If everybody, Don's like, you have a green screen. I know if I really had the adjust, because I was doing another program yesterday and I thought I had done it, but I didn't. There it is. There's my background screen. So Brandon, you can take it from me. I got to run this. Brandon, I'm going to tell you one thing. Jenga. Brandon, Jenga. This is Jenga. We are like right on the precipice of literally like rolling over and dropping 200 to 300. We're right on. And I don't care about like the intraday crap, Brandon. The weekly indicator is getting steeper and steeper and steeper. And once it starts to go 45 to 90 degrees, Brandon, we could blow down 200 points by the time you like finish your program. This is the most dangerous market I've ever seen in my career. What say you?
Well, I mean, it's certainly there, but throughout these conditions have been going on for months, right?
Don't care.
From when you look from a volatility standpoint, I mean, November 28th, if you look at forward volatility expectations, November 28th was the day where we revamped the whole selling approach, 5 to 10% correction territory. And so for me, it's like whether we're trying to estimate a 10%, 5 to 10% correction or 10 to 20, you're gonna go similar. Because if you think we're gonna really drop by 20%, plus you're in cash right now, right?
I am. I got 55%, but I don't think we're going to drop 20. I think it's going to be at least 15. About 15 will be done.
Well, but if you're 10 to 20, you're the same anyway, right? I mean, that's the point, is that we could quibble over 15, 20%. But the thing is, if you really think we're going to hit we're going to break a 5 to 10% correction, we're going to go beyond correction territory, then yeah, you really got to do some adjustments to your portfolio and have more cash, as you've mentioned. And but I think, like, again, since November 28th, having a 30% in cash and being hedged, it's been a very reasonable, because anytime, right, it can happen. And so, but the market needs to correct, though.
Oh yeah, Brandon, I said the weekly MACD is going. It's turned from a 20-degree angle. Right now it's at 35. By next week it'll be 40, and then all of a sudden it's like like Jenga, Brandon. You take out the bottom rungs, right? And the thing just topples over like a tidal wave. I can see it happening in slow motion right now. And everybody's like, but we're in some type of vol box. Not for very long we won't be. If we continue on this technical path, we won't be.
Yeah, no, we're in a very dangerous territory.
Oh my
And
God.
again, it's been for a few months, right? The same potential. The point is that when do you actually take action to reduce your portfolio risk? And the market's been up for a few days. Good time to consider doing that. So yeah.
Well, I got a lot of short trades and they're actually doing really well. They're helping immensely. So I'm breaking
Yeah.
even today. I'll take break even with a positive delta. In the
Yeah.
meantime, let me let you run with this and I'll
All
go
right.
crack
Have a good
into
one.
this stock. See you later, man.
Have a see you. All right. So I'm coming from Ghost Hour for Ghost Prince and Ghost Signals room. So we were just talking about using options as a stock replacement strategy. And but our topic for